Something unusual started happening in the markets today. Within a very short window of time, oil prices suddenly surged higher, and almost immediately the ripple effect spread across global markets. Traders who were watching energy charts closely realized that this was not just another routine price movement. When oil jumps aggressively, it often signals that something deeper is unfolding beneath the surface of the global economy. And within minutes of that spike, two other assets began to react in a powerful way: gold and silver. Now, here's the question that every serious investor in the United States is asking right now. Why do precious metals suddenly wake up when oil surges? And more importantly, could this be the beginning of a much bigger shift in the market landscape that most people are still ignoring? Because history shows us something fascinating. When energy shocks collide with financial uncertainty, capital begins moving in ways that can create massive opportunities for those who understand the signals early. Think about this for a moment. Oil is not just another commodity. Oil is the bloodstream of the global economy. It fuels transportation, manufacturing, logistics, aviation, and nearly every industrial process that keeps modern civilization running. When oil prices spike sharply, it sends a message across financial markets that something is changing in the balance between supply, demand, and geopolitical stability. And whenever that balance shifts, investors begin repositioning their money. But here's the interesting part that many casual observers miss. When oil surges, investors don't only look at energy stocks or crude futures. They immediately start looking towards safe haven assets. Assets that historically protect wealth during periods of inflation, uncertainty, and geopolitical tension. And that is exactly where gold and silver enter the story. At first glance, it might seem surprising. Why would metals react to energy prices? But if you understand the deeper mechanics of the global financial system, the connection becomes extremely clear. Rising oil prices can push inflation expectations higher. Higher inflation means investors start worrying about the purchasing power of their money. And when that fear starts growing, capital begins flowing toward assets that have historically preserved value during turbulent periods. But something even more interesting is happening in today's market environment. Gold and silver are no longer reacting purely as safe haven metals. They are also deeply connected to industrial demand, technological transformation, and the massive global shift toward new energy systems. Which means the same oil shock that triggers inflation fears can simultaneously strengthen the long-term demand outlook for metals like silver. Now, pause for a second and think about the bigger picture. The United States economy is navigating one of the most complex financial environments in decades. Interest rates have been volatile, inflation has been stubborn, geopolitical tensions are influencing commodity markets, and global supply chains are still adjusting to structural changes that began years ago. When all of these forces collide, markets can move very quickly and sometimes violently. This is exactly why moments like this matter so much. Because when oil spikes suddenly, it often acts like a signal flare in the financial world. It alerts traders, hedge funds, institutions, and commodity desks that the environment may be shifting. And when large institutional money begins repositioning, the impact can spread far beyond the oil market itself. Precious metals often become one of the first destinations for that capital. But here's the real question that serious investors should be asking right now. Is this just a short-term reaction that will fade away within days? Or is this the early stage of a broader commodity cycle that could push gold and silver significantly higher? Because if history has taught us anything, it is that major commodity moves rarely begin with loud announcements. They begin quietly with subtle signals that most people ignore until the move is already well underway. Let's go back in time for a moment. During previous commodity booms, the earliest signals often appeared in energy markets. Oil would start moving first, reflecting tightening supply or geopolitical stress. Then gradually, other commodities would begin following the same direction. Metals would start climbing. Mining companies would begin outperforming. And before long, what started as a small shift would evolve into a full-scale commodity rally. Now imagine being one of the investors who recognized those signals early. Instead of reacting late when headlines were already screaming about soaring prices, you would already be positioned. That is the difference between reactive investing and strategic investing. One follows the crowd. The other studies the signals that appear before the crowd even realizes what is happening. And right now, the markets are sending signals again. Oil surges, gold responds, silver accelerates even faster. Traders start whispering about inflation pressure, supply disruptions, and geopolitical uncertainty. These are not random movements. They are pieces of a much larger puzzle forming in real time. But before jumping to conclusions, we need to understand something critical. Not every oil spike leads to a sustained metals rally. Sometimes, markets overreact temporarily. Other times, the reaction becomes the beginning of a powerful trend that reshapes entire sectors of the economy. The key difference lies in the underlying forces driving the move. Are we witnessing a temporary shock, or are we seeing the early stages of a structural shift? Because if this oil spike is tied to deeper supply constraints or escalating geopolitical tension, then the reaction we are seeing in gold and silver might only be the beginning. And if that scenario unfolds, investors who understand the relationship between energy markets and precious metals could find themselves positioned ahead of a very powerful trend. This is why today's market movement deserves close attention, not because prices moved in a single day, but because the combination of energy volatility, inflation fears, and safe haven demand creates the exact environment where precious metals historically thrive. And when those conditions align, the results can surprise even experienced traders. But the story doesn't stop here, because the real mystery behind today's oil spike goes deeper than most headlines are explaining. Something triggered this surge, and understanding that trigger could reveal where markets are heading next. If the cause is temporary, metals may cool off quickly. But if the cause is structural, the ripple effects across commodities could be much larger than anyone expects. And this leads us directly to the next question that every serious market observer needs to understand. What exactly caused oil to spike so suddenly, and why are experienced investors treating this moment as the beginning of what some traders are already calling a market war? We'll get into all of that and what it could mean for your money. Make sure you're subscribed so you don't miss what's coming next. Thanks for watching. Have you seen the gas prices lately? It feels like every time you fill up, the numbers just keep climbing. Well, you're not imagining it. Oil prices have been on a wild ride, surging dramatically in recent weeks, and it's sending shockwaves through the entire global economy. Today, we're going to break down exactly what's happening, why it matters to you, and where smart investors are looking for stability in these turbulent times. So, what's pouring fuel on this fire? It's a complex mix of factors. A major driver is geopolitical tension. Whenever instability brews in key oil-producing regions, like the Middle East or Eastern Europe, the market gets nervous. The fear of potential supply disruptions, whether from conflict, sanctions, or political posturing, can cause prices to skyrocket almost overnight. Traders start pricing in the risk that the flow of oil might be choked off. And that fear alone is enough to send prices soaring, even before a single barrel is lost. But it's not just about what might happen. It's also about what is happening. We've seen major oil-producing nations decide to cut back on their output. When organizations like OPEC Plus announce production cuts, they're deliberately tightening the global supply. Less oil available on the market means buyers have to compete more fiercely for what's left, and that naturally pushes prices up. It's a classic case of supply and demand. And let's not forget, global demand for energy hasn't really slowed down. As economies continue to recover and grow, the world is thirsty for oil, and that strong demand meeting a tighter supply is a recipe for the price surge we're currently experiencing. Now, you might be thinking, okay, so oil is more expensive, but how does that really affect me beyond the gas station? The answer is, in almost every way imaginable. This isn't just about your daily commute. Oil is the lifeblood of the global economy. Think about it. Transportation costs for everything you buy, from the food in your grocery store to the clothes on your back, are directly tied to fuel prices. When it costs more to ship goods, companies pass those extra costs onto us, the consumers. This is a huge driver of inflation. Suddenly, your weekly grocery bill is higher, that online order has a bigger shipping fee, and even airfare for your vacation goes up. It's a ripple effect that touches nearly every corner of our financial lives. This brings us to the financial markets. How are they reacting to all this volatility? Well, it's a mixed bag, and it creates a fascinating, albeit nerve-wracking environment for traders and investors. When oil prices spike, energy stocks often get a boost. Companies involved in oil exploration, production, and refining see their potential profits increase, and their stock prices can climb. Traders who are quick on their feet might try to ride this wave, betting on continued high prices. However, for the broader market, it's often a different story. High oil prices act like a tax on the economy. They squeeze corporate profit margins for non-energy companies and reduce consumer spending power. This can lead to fears of an economic slowdown or even a recession. We often see a sell-off in sectors that are heavily reliant on consumer spending, like retail and hospitality, or industries with high transportation costs. The stock market as a whole can become shaky and uncertain. Investors get jittery, looking for signs of where the economy is headed next, and this uncertainty itself can lead to more market volatility. In times like these, when traditional investments like stocks feel like a roller coaster, seasoned investors start looking for a safe harbor. They turn to what are known as safe haven assets. These are assets that are expected to retain or even increase in value during periods of market turmoil. And for centuries, the ultimate safe havens have been precious metals, particularly gold. Why gold? Gold has an intrinsic value that isn't tied to the performance of any single company or government. It's a physical, tangible asset that has been a store of value for thousands of years. When inflation rises and the purchasing power of currencies like the dollar goes down, gold tends to hold its value, making it an excellent hedge against inflation. During geopolitical crises, investors flock to gold as a security blanket, a reliable asset when everything else feels uncertain. It's no surprise that as oil prices have been climbing and market jitters increase, the price of gold has also been on a steady upward trend. It's the market's vote of confidence in a time-tested store of wealth. But gold isn't the only player in the safe haven game. Its less famous sibling, silver, is also stepping into the spotlight, and for some very compelling reasons. Silver, like gold, is a precious metal and has been used as money for millennia. It also acts as a hedge against inflation and a safe haven during economic uncertainty. When investors get nervous, many will buy silver for the same reasons they buy gold. However, silver has a unique dual personality that makes it especially interesting right now. It's not just a precious metal, it's also a critical industrial metal. In fact, over half of all the silver consumed each year is used in industrial applications. You'll find silver in everything from electronics and solar panels to medical devices and electric vehicles. This industrial demand gives silver a completely different dimension. Think about the global push towards green energy. The transition to a more sustainable future is incredibly metal intensive, and silver is a star player. It's a key component in photovoltaic cells for solar panels. As the world builds more solar farms to move away from fossil fuels, like the very oil that's causing all this trouble, the demand for silver is set to explode. The same goes for the electric vehicle revolution. EVs use significantly more silver than traditional gasoline-powered cars. So, as we see more Teslas and other EVs on the road, we're seeing more demand for silver. This dual role creates a powerful dynamic. On one hand, silver benefits from the fear trade, where investors buy it as a safe haven during economic turmoil. On the other hand, it benefits from the growth trade, with its demand being driven by major technological and industrial trends that are shaping our future. This means silver has the potential to perform well, not just when the economy is shaky, but also when it's growing and innovating. So, while the surge in oil prices is creating headaches at the pump and uncertainty in the stock market, it's also shining a light on the enduring value of precious metals. Gold continues to prove its worth as the ultimate safe harbor. And silver, with its unique blend of monetary history and critical industrial use, is emerging as a uniquely positioned asset for the challenges and opportunities of the 21st century. It's a fascinating time to watch these markets interact, and understanding these dynamics is key to navigating the economic landscape ahead. Thanks so much for watching. If you found this breakdown helpful, be sure to hit that like button and subscribe for more deep dives into the forces shaping our financial world. Hey everyone, and welcome back to the channel. Today, we're diving deep into a metal that's often overshadowed by its flashier cousin, gold. But don't be fooled, silver might just be one of the most fascinating and potentially explosive assets you can own. We're going to explore why silver isn't just a pretty metal for jewelry, but a critical component of our future and a powerful store of value. So, what makes silver so special? Well, it lives a double life. For thousands of years, just like gold, it's been used as money. It's a tangible asset, something you can hold in your hand that has preserved wealth through empires rising and falling. When currencies devalue or inflation kicks in, people have historically turned to silver to protect their purchasing power. It's a safe haven asset, a financial bedrock. But here's where it gets really interesting. Unlike gold, which is primarily a monetary metal, silver has a massive and growing industrial side. In fact, over half of all silver demand comes from industry. Why? Because silver is a supermetal. It has the highest electrical and thermal conductivity of any element, and it's also highly reflective and has antimicrobial properties. This unique combination of traits makes it irreplaceable in a huge range of applications. Think about the device you're watching this on right now. Your smartphone, your laptop, your tablet, they all have silver in them. It's in the printed circuit boards, the touch screens, and the batteries. Every time you flip a switch, you're likely using silver. It's in our cars, our appliances, and even our medical equipment. It's the unsung hero of the modern world, quietly powering our lives behind the scenes. Now, let's talk about the future, because this is where silver's story gets incredibly compelling. The green energy revolution, the massive global push towards decarbonization, is fundamentally dependent on silver. Solar panels are a perfect example. The silvery lines you see on a photovoltaic cell, that's silver paste, and it's essential for converting sunlight into electricity. As the world installs more and more solar panels to combat climate change, the demand for silver is set to skyrocket. There is no viable, cost-effective substitute for silver in this application. More solar means more silver. Simple as that. And it doesn't stop with solar. Electric vehicles, or EVs, use significantly more silver than traditional internal combustion engine cars. It is used in everything from battery connections and electrical contacts to the heating elements for defrosting your windows. With almost every major automaker committing to an electric future, we're talking about a structural increase in silver demand that will last for decades. Then there's 5G technology. The rollout of faster, more reliable mobile networks requires a dense infrastructure of new towers and equipment. And guess what? This new hardware is packed with silver components to handle the higher frequency signals. So, our thirst for faster internet and connected devices is directly translating into more demand for silver. So, we have this ancient monetary metal on one hand, and this critical, future-facing industrial metal on the other. This dual nature is what creates such a unique and powerful dynamic in the silver market. Let's look at how this plays out. The supply of silver is relatively inelastic. It primarily comes from mining, often as a byproduct of mining for other metals like copper, lead, and zinc. This means that even if the price of silver shoots up, miners can't just flip a switch and produce a lot more of it. It takes years to find new deposits and build new mines. So, supply is tight and slow to respond to changes in demand. On the demand side, we have two major drivers that can move independently. The first is investment demand. When there's economic uncertainty, fear of inflation, or geopolitical tension, investors flock to silver as a safe haven, just like they do with gold. This can cause huge inflows of capital into silver ETFs, coins, and bars, pushing the price up. The second driver is industrial demand, which we've just talked about. This side of the equation is less about fear and more about global economic growth and technological innovation. As industries like solar, EVs, and electronics expand, their need for silver grows consistently year after year. This creates a strong underlying base of demand that's always there, consuming a significant portion of the annual supply. Now, here's the magic moment. What happens when both of these demand drivers fire at the same time? What happens when you have a period of economic uncertainty causing investors to pile into silver while, at the same time, the green energy transition is demanding more and more physical silver for industrial use? This is when you get the potential for a massive price squeeze. You have a fixed, slow-moving supply being hit by a tidal wave of demand from two completely different sources. Industrial users need to buy silver no matter the price, because it's essential for their products. They can't just stop making solar panels or iPhones. At the same time, investors are buying it up to protect their wealth. This is what makes the silver market so famously volatile and capable of explosive moves. Historically, when silver gets going, its percentage gains can far outpace those of gold. The market is much smaller than the gold market, so it takes less money to move the price significantly. Think of it like a small boat in a big storm. The waves can feel much bigger. We've seen this happen before. In the late 1970s and again around 2011, a combination of monetary fears and market dynamics led to spectacular price surges. Many analysts believe we are setting up for a similar scenario today, but potentially on a much grander scale. The industrial demand story is stronger now than it has ever been in history. The long-term trends of electrification and decarbonization are not going away. They are accelerating. At the same time, global debt levels are at all-time highs, and central banks continue to print money, raising serious questions about the long-term value of fiat currencies. This creates a perfect storm for a monetary asset like silver. It's important to understand that silver is not a get-rich-quick scheme. Its price can be volatile in the short term. But when you look at the fundamental supply and demand picture over the next 5, 10, or 20 years, the case for silver becomes incredibly compelling. We have a situation where demand is structurally increasing due to technologies that are essential for our future. We have a supply that is constrained and cannot easily keep up. And we have a centuries-old history of silver acting as a safe haven and a protector of wealth during uncertain times. When you combine these factors, you realize that silver isn't just a poor man's gold. It's a unique strategic asset with two powerful engines for growth. It stands at the intersection of past and future, of monetary value and technological necessity. Whether you see it as a hedge against inflation, a bet on the green energy transition, or both, silver's dual role makes it one of the most interesting assets to watch in the coming decade. The quiet, industrial workhorse might just be about to have its moment in the sun. Thanks so much for watching today. I hope this gave you a new perspective on this incredible metal. What are your thoughts on silver's future? Let me know down in the comments. And if you found this video helpful, be sure to hit that like button and subscribe for more content. We'll see you in the next one. As investors began absorbing the news of the oil surge and the rising momentum in precious metals, another question quietly started circulating through trading desks and investment circles. A question that could ultimately determine whether this moment becomes a short-lived reaction or the early stage of something much larger. That question revolves around supply. Because in commodity markets, the balance between supply and demand often decides the direction of long-term price trends. Silver's demand story has been gaining attention, especially with its growing role in modern technologies and renewable energy systems. But demand alone does not create explosive market moves unless supply begins tightening at the same time. And this is where the silver market becomes particularly intriguing. Unlike many commodities that can increase production relatively quickly when prices rise, silver mining operates under significant constraints. Developing a new mine can take years, sometimes even decades, from exploration to full production. This means the supply response to rising demand is often very slow. Many silver deposits are also mined as byproducts of other metals such as copper, lead, or zinc. That means silver production is not always controlled directly by silver demand. Instead, it depends on the production cycles of other mining industries. If those industries slow down, silver output can fall even if the demand for silver itself remains strong. This creates a situation where the market can tighten unexpectedly. Now imagine the scenario unfolding in today's environment. Demand for silver continues growing due to technological expansion and industrial usage. At the same time, investors begin buying the metal as a hedge against inflation and economic uncertainty. If both of those forces accelerate simultaneously, the pressure on supply becomes increasingly visible. And when markets start noticing that available supply cannot easily expand, the psychology of investors begins to change. This is where institutional money often enters the story. Large hedge funds, commodity trading firms, and asset managers constantly monitor supply-demand imbalances across global markets. They look for opportunities where structural pressures might lead to major price movements. When they identify a market where demand is rising while supply struggles to keep pace, they begin positioning themselves early. Sometimes these moves are subtle at first. Large investors quietly accumulate positions over time rather than announcing their intentions publicly. When that kind of strategic accumulation happens in a commodity like silver, it can eventually create a tipping point. Once the broader market realizes that significant capital has been flowing into the metal, momentum begins building rapidly. Retail investors notice the rising prices. Financial media starts covering the story. Suddenly, what began as a quiet accumulation phase transforms into a powerful rally, driven by widespread attention. But before reaching that stage, markets usually go through several possible scenarios. The first scenario is the calm outcome. Oil prices stabilize after the initial spike. Inflation fears cool down. Precious metals pull back slightly as investors take profits. In this case, the recent movements would represent a temporary reaction rather than a lasting trend. The second scenario is far more interesting. Oil remains elevated because supply concerns continue lingering. Inflation expectations stay strong. Investors gradually increase their exposure to commodities as a hedge against rising costs. In this environment, gold could continue attracting defensive capital, while silver benefits from both investment demand and industrial demand. This scenario could push metals steadily higher over time. Then there is the third scenario, the one that often captures the imagination of commodity traders. In this case, energy volatility continues. Geopolitical tensions remain unresolved, and industrial demand for metals keeps expanding. Investors begin viewing commodities as essential assets in a changing economic landscape. If that mindset spreads across institutional portfolios, the resulting inflows of capital could push precious metals into a powerful upward cycle. What makes this scenario particularly compelling for silver is its relatively small market size compared to many other commodities. Because the market is smaller, it takes less capital to create significant price movement. When institutional investors allocate even a modest portion of their portfolios toward silver, the impact on price can be dramatic. This is why silver has historically experienced some of the most explosive rallies in the commodity sector. However, experienced investors also understand that volatility works in both directions. The same forces that push silver upward quickly can also create sharp corrections along the way. Commodity markets are known for their dramatic swings, and successful participants learn to navigate those swings with patience and discipline. They pay attention to underlying trends rather than reacting emotionally to every short-term fluctuation. Right now, the signals emerging in the market are attracting attention for a reason. Oil's sudden surge has reminded investors how sensitive the global economy remains to energy disruptions. Gold's response highlights the growing demand for financial protection. Silver's momentum reflects both investor interest and industrial necessity. When these three forces begin aligning, it often suggests that the commodity landscape may be entering an important phase. But understanding signals is only part of the equation. The real challenge for investors is interpreting those signals correctly and preparing for what might happen next. Markets rarely move in straight lines. They advance, pause, retrace, and then sometimes accelerate again. The ability to remain focused on long-term forces rather than short-term noise is what separates disciplined investors from those who constantly chase headlines. This is why moments like the current one deserve careful attention. The oil spike might appear to be just another day of market volatility, But beneath that volatility lies a complex web of economic forces shaping the future of commodities. Energy markets, inflation expectations, industrial demand, and investment flows are all interacting at the same time. Each of these forces alone can influence prices. Together, they can reshape entire sectors of the global economy. And as these forces continue evolving, one final piece of the puzzle becomes extremely important. Investors need to step back and summarize what all these signals actually mean. Because once the noise of daily headlines fades away, when we step back and look at everything that has unfolded, much clearer. A much clearer understanding that lesson could help investors. What initially seemed like a simple spike in oil prices is actually connected to a much deeper set of forces moving through the global financial system. Oil surged suddenly, and that surge immediately triggered reactions across multiple markets. Investors began repositioning their capital, searching for assets that could protect them during uncertainty and inflation pressure. Almost instantly, gold responded as the traditional safe haven. Silver followed with even stronger momentum, reflecting both investor demand and its growing importance in modern industry. But the story did not stop with a single price movement. The oil spike reminded investors how sensitive the global economy still is to energy disruptions. When energy becomes unstable, inflation concerns rise quickly. Transportation costs increase, manufacturing expenses grow, and the ripple effects eventually reach consumers. In those moments, investors begin asking a simple but powerful question. Where can wealth be protected when the cost of living begins climbing again? For centuries, precious metals have answered that question. Gold represents stability during uncertainty, while silver offers both protection and participation in industrial growth. As we explored earlier, silver holds a unique position that very few assets can match. It behaves like a precious metal during financial stress, yet it also plays a critical role in the technologies shaping the future economy. Solar energy systems rely on silver's unmatched electrical conductivity. Advanced electronics depend on it to power circuits and components. As the world continues expanding its technological infrastructure, the demand for silver quietly grows stronger year after year. This means that when investors start buying silver for financial protection, they are entering a market that already has powerful industrial demand pushing from another direction. At the same time, the supply side of the silver market faces real limitations. Mining production cannot expand overnight. New projects require years of exploration, financing, and construction before they can produce meaningful output. Many silver deposits are also mined alongside other metals, meaning silver production depends partly on the economics of completely different industries. When demand grows faster than supply can adjust, pressure builds within the market. That pressure often remains invisible until suddenly prices begin responding in dramatic ways. Now combine all of these forces with the current market environment. Energy volatility has returned. Inflation concerns are lingering in the background. Technological demand for metals continues rising, and global investors are watching commodities more closely than they have in years. When these elements intersect, markets can shift in ways that surprise even experienced analysts. What begins as a single event, like an oil spike, can evolve into a much larger movement across the entire commodity sector. However, the most important lesson from this moment is not simply that prices move today. The real lesson is that markets constantly send signals long before major trends become obvious. Oil rising sharply signals potential energy stress. Gold responding quickly signals investors seeking safety. Silver accelerating even faster signals that industrial demand and financial demand may be colliding at the same time. When these signals appear together, disciplined investors pay attention. They step back from the noise of daily headlines and focus on the underlying forces shaping the future. That is exactly why understanding these relationships matters so much. Markets reward those who study patterns, recognize signals, and think ahead rather than reacting late. The investors who succeed over the long term are not the ones chasing sudden price moves. They are the ones who understand why those moves happen in the first place. They connect energy markets with inflation expectations, industrial demand with technological transformation, and global uncertainty with the timeless role of precious metals. The events unfolding right now may turn out to be temporary market volatility, or they could represent the early stages of a larger shift in commodities. Time will ultimately reveal which path the market chooses. But one thing is certain, moments like this remind us how interconnected the global financial system truly is. A surge in oil can ripple into metals, currencies, and equities within minutes. For investors who understand those connections, opportunities begin appearing long before the broader public recognizes them. If you want to continue understanding these signals and stay ahead of the forces shaping the markets, make sure you subscribe to Signalscope Markets. On this channel, we break down major developments in commodities, precious metals, and global financial trends so you can see the bigger picture behind every market move. And if you want to know what signals traders are watching next as this market story continues developing, stay tuned to the next analysis here on Signalscope Markets.